And so I appreciate you taking some time out of your day. We're going to go through an eclectic group of retirement topics this morning. You see the title of the presentation is, Retirement Greatest Hits. So I just called it that because I do a lot of employee meetings, and I think these topics that we'll discuss today are ones that come up quite frequently, just things that people really want to know. So hopefully you'll enjoy this information. And again, send questions via the chat if you have them, and we'll have time for Q&A at the end. You'll get all of our contact information. So let's go ahead and get after it. We got some objectives, and these are the topics that we'll run through in the presentation. How much you will need to retire. So we'll look at retirement savings needs, why that time matters, that time horizon, how long you have and until you're going to begin using this money. And then we want to even think about, how long you're going to be alive. So looking at that retirement and when you start to withdraw money, but even going beyond that, how long are you going to need to make this money last? Pre-tax and Roth savings, and then talk about some impacts of accessing retirement money. So those are all our objectives. Hold me to account. We'll check back in at the end, make sure we learned a little bit about each of those. And our first one is retirement savings needs. So looking at how much you're going to need for retirement. We'll look at this a few different ways. And if you've joined any of my webinars in the past, I like to use this slide. So it looks at retirement income sources. And we'll look at these different segments, but I put on here, some different income levels, and then we'll see where the retirement income comes from for these individuals at these different income levels. So first, I always like to talk about how your income needs change in retirement. And I will always talk about replacing something like 75 to 80% of what you lived on pre-retirement. And that's because as we see across this income range, what most retirees live on is something like, 75 to 80% of what they lived on pre-retirement. So their spending changes. You'll spend more in some areas, less in others, but you tend to spend a little bit less. And of course, you're not saving any longer for retirement, so you don't have to worry about that. Your tax situation might change. So that's why people will generally live on somewhere around 80% of what they lived on pre-retirement. Now that money's going to come from a few different sources. You might have more sources than this, but just in general, we'll look at how Social Security will be part of your retirement income. And you can see further on the left of this chart, Social Security makes up a bigger chunk of what these individuals will likely live on in retirement. Further to the right, higher income individuals, Social Security is going to make up a much smaller piece. And so the gap, then that green portion, is what we would have to come up with out of private sources like our savings, like our 401k, 403b. And this number is what we're going to focus on. So there you can get a feel, you can look at where you fall on the income spectrum. And that green number is really what we want to focus on. So if you're including Social Security in your plan, that green number is what you want to focus on, what you would need to come up with out of pocket from things like your 401k, 403b to maintain your same standard of living in retirement. And most of my examples that I have are going to be at the $70,000 range. So if I just draw your attention to that for a moment, you see $70,000. It says they're going to live on 80% of that in retirement on average, and they're going to need to come up with about 34% from private sources. So let's soldier on, and we'll put some numbers to that. So I call this a reverse calculation, just because most people they'll think about how much they have, a pile of money, that nest egg, and then adjust and say, okay, this is how much I have, how much can I get by? How much can I live on with that? And so we still have time on our hands. You're still working, saving for retirement. So we're going to reverse that, and we're going to look at how much are you going to need, and then based on those needs, what kind of nest egg do you need to come up with? So I said like 70,000. So if we look at somebody makes, gross income pre-retirement, 70,000, and 80% of that, they're going to be looking at living on about $56,000 in retirement. Social Security will make up a chunk of that. So we subtract out Social Security. So 56,000 minus, if they're making about $32,000 a year in Social Security, that gives us our retirement income gap. So that gap between those guaranteed monthly checks like Social Security, or if you're fortunate to have a job maybe that had a pension, something like that. So you look at what's 80% of what you make today, that's what you're going to live on in retirement. Subtract out those guaranteed sources like Social Security, pension, and that gives you your gap. Okay, so now you know what you need to come up with out of your savings or your private investment sources. And we're going to use 5% as a safe withdrawal rate. We'll see in just a moment why I use 5%. But if we say 5%, that's a safe withdrawal rate. So if you need to come up with $24,000 a year, you can safely withdraw 5%. We divide that 24,000 by 5%, and we come up with our savings goal for this person in the neighborhood of $500,000, 480,000, to be comfortable, to maintain their standard of living, and have a pretty high likelihood that that money is going to last as long as they're alive. So that's a quick, easy way to do some retirement planning. If you saw on that previous slide what you need to come up with out of your savings, divide that amount by 5%. That's going to give you a pretty good target to aim for. And I mentioned I talk about why that 5%. Well, here on this chart, we have those different withdrawal rates. So you see 3, 4, 5, 6, 7, 8%. And then some different portfolios. So all stock portfolio, going down to just 20% in the stock market, 80% in bonds, or like those fixed type of investments. And you can see in 5%, I used 5% because that gives us a pretty good probability that at a 5% withdrawal rate, our money is going to last 30 years. So that means retiring, let's say in your early to maybe mid 60s, that money's very easily going to last into your early to mid 90s. Now look at those other areas of this chart, and you get a feel for, see if you're, and I use 5% because that's more of an achievable withdrawal rate. I mean, ideally, yeah, if you can withdraw just 3, 4%, you see that probability goes up, where then you're in a situation where maybe you don't have to have as much exposed to that market risk and in the stock market, and still have a very high probability that your money's going to last as long as you're going to need it. You go into a higher withdrawal rate, 6, 7, 8%, and you see now you're getting like below 50%, or you're being like at a 6% withdrawal rate, you're being forced into an all stock portfolio to try to make enough to make that money last. So that's why I use that 5%. You can see on those different portfolios, a mix of stocks and bonds gives you a pretty good probability that the money's going to last as long as you're going to need it. So that's why I use that for that reverse calculation. Hopefully you're crunching some of those numbers along with me and getting a better feel for how much you need in retirement savings. If not, another rule of thumb that we'll use is just this multiples of income. So you see over there on the far right, when you get to retirement, a rule of thumb is, something like 8. I mean, if you can be above 8, if you can be like 10 times your annual income, then you're even in a better situation. But certainly 8, we saw with our previous example, it's somebody making 70,000, they were at about 7 times. So like at 480,000, about 7 times, they were probably going to be okay. And then those different benchmarks along the way. So there, find your age. If you're in your middle age, maybe early 40s, you want to have something like 3 times your annual income saved to make sure that you're on track to get up to that 7 or 8 times your annual income in your nest egg to provide for your retirement. So they're just a rule of thumb, getting upwards of 8 times your annual income. Some more checkpoints to help you along the way, achieving that successful retirement, it takes discipline and time. This kind of ties into our next segment that we'll get to with time horizon. But as you'll notice here, the well, that's on our next slide. I'm getting ahead of myself just a moment. So first, let's look at these checkpoints. See if you're on track. So 40, again, somebody that's about middle age, 40, making $70,000 a year. We saw in that previous slide, they're going to want to have somewhere around 3 times, maybe 2.5, 3 times. So, maybe this person's got $150,000, $170,000 saved for retirement. They're looking pretty good. Maybe they could do a little bit more, but they're in a pretty good spot. Now, maybe you're not in that situation. Maybe you're just getting started saving for retirement. Maybe you're a little bit late at getting started saving for retirement. And what I just showed you and those checkpoints and this slide as well, they're pretty conservative projections. So, if you're hitting these numbers, you're in a pretty good spot. But, maybe you don't have the retirement savings yet. You're a little bit behind. You're wondering, well, okay, thanks, Greg. We're looking at how much do I need to save? What's that nest egg that I need? But how do I get there? I have no idea how much I should be saving. I mean, use your 401k, 403b website. There's lots of good tools out there today you just log into your website and it's going to give you an idea whether or not you're on track. But let's look at this 40-year-old again. If they just get started saving now, so as we saw in the previous slide, they don't have 160, 170,000 already saved for retirement. They got 0. So they're just getting started. They make 70,000 a year. You see, we're quickly up into that 20% range is what they need to be putting away to be on track then, because they're limited in time. You see, if somebody starts in their 20s, they're single digits, they're going to be okay. And most 401k, 403b plans are offering some kind of match. So that's going to help you. But you get into your 40s and you're just getting started saving for retirement. I mean, even with a generous employer match of something like 5%, I mean, to be on track, you're still going to have to be putting away something like 15% on your own to be on track. So time is huge, which we'll get into next with time horizon, but hopefully that ticks off the box for that objective, talking about how much you're going to need for your retirement. And we're always here to help you with that if you want to talk about that in more detail. But why does time matter? Well, we've already seen a little bit why your time matters, your time horizon. And when we talk about time horizon, that's really the number of years until you retire, because that's going to determine your asset allocation, how much risk you can take with your money. So, here just again some general information, 15 or more years until retirement, you're pretty safe having most of your money in the stock market because you can stomach a little bit more of that market risk because, even if the market hits a bump in the road, it's going to come back by the time you retire. 5 to 15 years, you're getting closer. That's the time where a lot of people are dialing it back a little bit, or if you use things like a target date fund in your retirement account, they're going to start to dial it back a little bit, the exposure to the stock market, and certainly within 5 years of retirement. But I put these numbers up there, these are not hard and fast rules, and I also want to get you to start thinking about not just to retirement as a destination, but through retirement and for as long as you're alive, because these are my retirement greatest hits. So when I'm out there talking to employees, we're all focused a lot on that retirement date, when you're going to retire, when you're going to start drawing on this money. But that's not the end. As we, based on life expectancy, and as we saw in one of my previous slides, you want to plan for using this money even post-retirement for another 30 years. So you want to start to think about that through retirement. So your time horizon is probably even longer than you realized. And so that's why we're going to have some exposure to the stock market, even as we retire, to make sure we can try to get that money to last as long as we're going to need it, so to make it last that 25, 30 years. Because if you remember on that chart where we saw those different withdrawal rates, the probability of your money lasting as long as you're going to need it, if you have some exposure to stocks, which historically offer more return, it's more likely that your money's going to last throughout your life. So that time horizon would not just to retirement, but through retirement. Why is that time horizon important? Well, one thing is compounding, and we saw that already on some of the previous slides. Time, if you have it, is your best friend. If you're getting close to retirement, your time can start to become your worst enemy. But the longer you have, it's that compounding that happens with your money. And you can see on this slide, a few $100 invested in the market. After just 5 years, most of it's the deposits that you made. Just about a third of it is the interest or the growth. But you go on in years, and like many of us on the line probably have 20 plus years until retirement, and you see your account ends up being mostly earnings, and that's that idea of compounding, that snowball effect. So the longer you have, the more your money can grow. So the sooner that you can make a change, then it's that ripple effect. That tiny change that you make today will have a huge impact down the road. So that's one of the reasons why your time horizon and time matters. Another is stomaching and dealing with those bumps in the road. So, market downturns, they happen all the time. We'll see how frequently, just over the last, 70 years or so, how often the market has hit a bump of 5% or more a year. Generally happens a few times a year. I mean, take earlier this week, what are we on Monday? I mean, the market was it was down 2+%, and then yesterday it came back. So yeah, not 5%, but you see these fluctuations in the market. 10% about once a year. They call that a correction when it's 10%. 15%, getting into that 20%, like we saw in 2020 with the pandemic. They happen, every handful of years, and so your time horizon is important because if you're getting short on time, if you're definitely going to need to be counting on this money, and this is even more true for things like emergency savings rather than, retirement savings. But if you're going to be counting on this money and you're getting within a handful of years, so like, 3 to 5 years, you want to have less exposure to the stock market because it's very likely in that period of 3 to 5 years, there is going to be a time where the market's down 10-15%. You don't want that to happen at the wrong time when you're counting on accessing this money. So that's certainly why time horizon is important, because if you have more time, you can ride out those bumps in the market. If you have that certainly 5+ years, 10+ years until you're needing to access this money, then don't worry about those little bumps in the road. Something like, if you follow the market closely and you see what happened on Monday, that shouldn't phase you in the least, because you're not going to be accessing this money for a long time. Historically speaking, the market over a 10-year period, it's always going to be up. So the longer you have, the less you have to worry about those bumps in the road. And this chart will show us that with those range of returns, again, over a long period of time, something like 70 years. So some different investments. You have your stock portfolio, bond portfolio, and then a mix, 50-50. And you can see in any 1 year period, yeah, there are great years in the stock market where it's up almost 50%, but there are years where it's down 30+%. And take us back to like 2008. I mean, 2020, what the market was down 34%, at the worst spot, but then bounced right back. So 2020 was kind of an odd year where it was down so quickly, but then back very quickly. But those 1 year periods, yeah, the market can move around a lot. Now you start to stretch that out. 5 years, much less likely that it's going to be down. And look at that 50-50 portfolio already, 50-50 portfolio already in the 5 year period, not seeing negative numbers. So if you have that diversification, you're investing in stocks and bonds, you're within the 5 year, or you have 5 years or more, you're already not needing to worry about those negative returns, at least historically speaking. 10 years and 20 years, and you see the ranges start to tighten out at 20 years. Then even if you have a 100% stock portfolio, there's still no negative numbers. So that's why that time horizon matters, is because the longer you have, the more I want you to just ignore the noise and deal with those bumps in the road, because if you have longer time to go until you retire, you want to grow your money. Don't worry about what's happening on the day to day or the short term, those 1 year returns in the market. If your time horizon's shorter, then yes, we certainly need to start to be more aware of that. But remember, your time horizon, it doesn't just stop at retirement. You could very well be alive for 25, 30 years. So that's why you still want to have some of that exposure to the stock market, even though it's going to move around a bit, to make that money last as long as you're going to need it. So working our way through, we're talking about how much you need to save, why time horizon matters, why we always talk about how much time until you retire. Roth pre-tax is another very popular one. So we're going to talk a little bit about Roth and pre-tax. This likely is an option in your 401k, 403b. It may not be. You may only be able to save pre-tax, but if you have both options in your plan, just a refresher on what the difference is between pre-tax and Roth. I always call the pre-tax the tax me later option. That's because contributions are not taxed, but with Roth, it's a tax me now. Contributions are taxed. Then when you go and take the money out, pre-tax, that's why, again, I call it tax me later. No taxes on your contributions, taxes on the withdrawals. Roth is a tax me now, where you pay taxes on your deposits, so that when you get to retirement, you don't have to pay a tax on anything that you take out, either the deposits or any of the interest that money makes. As long as, again, you're 59 and a half, have 5 years to go. That's key with the Roth. You want to make sure that you have at least 5 years, because good old Uncle Sam wants you to have that money, or at least that Roth portion, going on your account for 5 years to be able to take advantage of those tax benefits. So side by side, let's look at pre-tax Roth. Again, I call it pre-tax, tax me later, Roth, tax me now. So the taxes are the key difference with how pre-tax and Roth are handled. The maximum contribution that you can make into a 401k, 403b, it's going to be the same for 2021, 19,500 if you're under 50, up to 26,000 if you're 50 or older. That is the combination of both pre-tax and Roth. That does not count any company matching contribution or employer matching contribution, but it's the total. You cannot put 19,500 pre-tax and $19,500 Roth. You can put 19,500 as an individual total across both Roth and pre-tax. So same there. The contribution maximum is for you as an individual. Rollovers. So your pre-tax dollars, they can go into another 401k, 403b, into a traditional rollover IRA, individual retirement account. Your Roth portion can go into another Roth 401k, 403b account. So same to same, or a Roth IRA, a Roth individual retirement account. The RMDs are the required minimum distributions. So this is something that used to be age 70 and a half. Maybe you've heard that age, but now it's 72. So this is when you're required to start taking at least a little bit out of your retirement accounts each year. And it's 72 for the pre-tax because the government wants to start collecting some of the taxes on those dollars. Remember, they've never been taxed, so it's 72. Assuming you're retired, you're separated from service, then you're going to have to start taking a little bit each year. Now, with the Roth, so with employer plans like a 401k, 403b, that's going to be included in your required minimum distributions, but you have the option. You can roll your Roth dollars to a Roth IRA, and Roth IRAs don't have those required minimum distribution requirements. So you do have the flexibility with Roth dollars to not be forced to start to take minimum distributions at age 72. Where any pre-tax dollars, traditional type of IRAs, there's no option. At 72, you got to start taking minimum distributions. And then just some of those stipulations there down there at the bottom. 59 and a half age still applies. For the pre-tax dollars, there's no tax penalty after 59 and a half. And for Roth, it's the tax-free distributions after age 59 and a half. Again, assuming that that Roth stopwatch has run for 5 years, so 5 years since you made your very first Roth deposit. And yeah, a question came in chat, so I'll get to this right here. The best order to withdraw money from retirement accounts, pre-tax or Roth? And that's an excellent question and up for a lot of debate. There's a lot of debate that goes around, what you should draw from first. I guess I'll frame it this way. If you have both Roth and pre-tax, you have flexibility. So, I am kind of partial to the tax bracket method. So, you can withdraw those taxable dollars like a pre-tax up to that tax bracket. And then if you need more, you can draw down your Roth dollars so that you can keep yourself in a lower tax bracket. Hopefully that makes sense. But you have that flexibility with Roth and pre-tax. Other people will argue draw down those pre-tax or those taxable first, and then just keep the Roth as long as you can. I mean, it also depends on your individual. This is a lot of, these financial economic answers where it depends, but it does depend on what are your goals? Is this, or do you want to leave money to heirs? Is this a legacy? Remember, with Roth, you're going to be able to do that. With pre-tax dollars, you don't have that same flexibility because you got to start to take those minimum distributions. So some of your goals factor in, but I'll give you my personal opinion. I'm kind of partial to the tax bracket method. And if you have both pre-tax and Roth, it gives you that flexibility. Then in retirement, you can figure out how much of your Social Security is going to be taxed. How much can you take out of your pre-tax dollars to not boost you into a higher tax bracket? And then if you need more, pull from the Roth, and you have that flexibility. So hopefully that gives you some more information there. Thank you for that question. How to choose? We'll see on my next slide. I think I always talk about the two T's, taxes and time. This slide will talk about it a little bit more. If you're sure that you're going to be on a lower tax bracket at retirement, you want more take-home pay today, pre-tax is going to be the way you want to go. If you think taxes are going up, you're in a lower tax bracket today, maybe you're ineligible for a Roth IRA because your income is too high, then you want to look into your Roth 401k, 403b. But again, it's taxes and time. So the two T's, I would say, that factor into what you do, pre-tax or Roth. Let's say the lower your tax bracket is today, the more attractive Roth is. Because why not pay the taxes today if you're in a low tax bracket? Because you're just getting started in your career, you're young, maybe your significant other, your spouse is not working, and so you're in a lower tax bracket. Why not just pay the taxes, be done with it, be able to pull tax-free in the future? Time is the other one. How much time do you have? The longer you have to grow that money, the more interest and earnings you can take tax-free from Roth deposits. So the lower your taxes or the longer you have in time, the more attractive Roth gets. Now, as you move along in your career, you probably are creeping up into a higher tax bracket. So that makes pre-tax more attractive. If you get killed every year on taxes, you want all the tax breaks you can get. So you're probably going to put money in pre-tax. If your time gets short, you get closer to retirement. As this chart on the right kind of shows us as you progress, in your working years, your tax brackets. Usually the older you get, the less time you have until retirement, the higher your tax bracket, then, pre-tax is looking more attractive. But as we were just discussing on the previous slide, having both gives you options. So I have nothing against having both pre-tax and Roth because it gives you flexibility in how you take that money out in your future retirement. So last segment is impacts. We'll talk about some impacts of taking money out of your account. This always comes up in 401k, 403b meetings. One scenario, or we'll walk through some scenarios, but one option that you might have in your plan, not all plans have this, so don't take this as an endorsement for your retirement plan that you have this as an option. You may or may not. but loans are sometimes an option with a 403B or 401k plan. So we'll look at some different scenarios with loans. Just a refresher, if you take a loan from a retirement plan, that's where you borrow your own money, pay it back into your account with interest. So it's a temporary distribution, or taking money out of your account that you're going to pay back. These different scenarios that we'll look at, one is the ideal loan scenario. So you take a loan, but you keep saving. You don't change what you're putting into your account. So this person, they're going to take a loan, $5,000, 5 years, they're going to pay that loan back. They're paying 5% interest, of course, paying interest to themselves. So they're not making interest or earnings on that $5,000 in their account because they took it out of their investments, out of their account. What their balance was, what they contributed, what their employer matched. It just so happens in this case, I set it up so that investment returns are, the same as, what you'd be paying in interest on the loan. But of course, it does impact your account. Your money is going to be, well, I should say, we'll see that on the next slide, on how much, in this scenario, it's really only fees. So if you keep contributing, you keep everything the same. Let's say the interest that you're paying to yourself is the same as what you'd be making on your investments. And then it's sort of a wash. This is the ideal scenario. This isn't what happens most of the time, to be frank, with 401k, 403b loans. But if you have to borrow, keep up your contribution. Don't change that. This next scenario is a little bit more common, where somebody takes a loan and then they stop their contribution. So this is where we see it's really going to impact them, because now they don't have money going into their account. They have money that they took out in the loan, so that's not earning that growth that they would see if they would have just left the account alone, and can cost them thousands of dollars in retirement savings. And this reminder, this is where the investment return is the same as the interest rate that somebody would be paying themselves on that loan. Of course, if the market takes a big hit, while you have the loan, having that money out of the market, I mean, there is a scenario where the loan might benefit you if you timed it perfectly, took a loan, and then the market tanked. I mean, it might benefit you, but if you're taking a loan for a period of something like 4 or 5 years, the market's almost certainly going to recover in that time. So I still wouldn't recommend something like a loan unless you absolutely have to. Stretching it out more, looking at something like 30 years, I mean, then you can see how much taking that loan back in the day can really impact this person's overall retirement savings situation. So yeah, it may not sound like the worst thing ever, taking a 401k loan, but stretching it out over time, increasing that return, if you look at more of like an 8% return on your money, then we're talking serious dollars. So, 401k, 403b loans, be wary, and then also understand what you're getting into, because if you have a loan on your account, you leave your job, that remaining loan balance is money outside of your retirement account. It's your responsibility to pay that back. If you can't, Uncle Sam's going to come knocking and want taxes and possibly penalties if you're under 59 and a half on that remaining loan balance. So here we see, let's say this person took that $5,000 loan, they paid, a chunk of it back. Maybe they paid $100 a month for a year, paid it down to $3,800, but now, they lose their job or they change jobs. They don't have the money to pay that loan off. So now they're going to get hit with some federal taxes, state taxes, and a penalty. And taking what they thought was just an easy $5,000 loan, now they're going to get hit with $1,000 in taxes and penalties because they changed jobs or lost their job while they had that loan outstanding. So go in with your eyes wide open. Some do's and don'ts on loans, make it a last resort. Evaluate your different options. Keep your contributions going in. As we saw in some of those scenarios, the biggest thing is keeping money going into your account. If you keep it all status quo and keep that money going in, it's not going to hurt you really. But the other thing I would recommend is post loan. mean, if you have a loan payment coming out of each paycheck, when you're done paying off that loan, then increase your 401k, 403b. I mean, you've had that money come out of your paycheck anyway, increase it, and that puts you in a better situation coming out of the loan. Some of the don'ts, don't take more than you need. Don't stop your contributions so that you don't miss out on any match. And then, understand the repercussions going with your eyes wide open, because if you leave your job, you have that loan outstanding, you're going to get hit with taxes and possibly a penalty on that. The other option that you might have in your retirement account is something they call hardship withdrawal. So this is where you have to prove that you qualify under one of these scenarios to be able to take out money permanently. So unlike a loan, it's not paid back. It's a permanent withdrawal, but it's limited to the amount that you need for one of these specific reasons. And so I'll just walk through quickly. These different reasons are like medical expenses, so stuff that's not covered by insurance, but medical expenses that you have. And again, you have to provide documentation to show that you're using money for those medical expenses for you or your spouse. Money that you need to purchase a principal residence. That's another thing that might qualify for a hardship. Not counting mortgage payments, but this is money to buy your principal residence, to avoid eviction or foreclosure. And again, you're going to have to provide documentation that shows, this is what I'm behind on rent. This is what I need to avoid foreclosure. Money to repair your principal residence. If there's a natural disaster, your home is damaged, that is what the IRS also considers a hardship. Post-secondary things like tuition, education costs for you or one of your dependents, spouse. So that also qualifies as a hardship. And then funeral expenses, for again one of your spouse or your dependents that pass away, you can get funeral expenses. So these are those hardship scenarios. So hardship different from a loan. You got to qualify. You got to provide documentation to show that you're using the money for one of those reasons. So let's look at them side by side. If maybe you have both these options available in your plan, what do you look at? Well, to get $5,000, if we are looking at that loan of $5,000, you borrow $5,000, no taxes. As long as you repay the loan, you keep your contributions going in, not so bad. A hardship withdrawal, now you're going to need to withdraw a lot more to get that $5,000 because you're going to have to pay taxes. So you'd have to actually withdraw more, and count all those taxes to net out $5,000. So even though it might sound nice to be able to take a hardship, be done with it, just a permanent withdrawal, you don't have to pay it back. I mean, I would say a loan is better because at least you're going to make your account whole, you're going to pay it back, and you don't have to take as much to end up netting that amount that you're going to need. I think we're going to check back in on our objectives then, as we get to Q&A. Hopefully we ticked all these boxes, so we looked at how much you're going to need to retire. We talked about savings needs, that withdrawal rate, asset allocation to make sure your money's going to last. How much do you actually need to save to achieve those goals? Why time matters, looking at your time horizon, those things like compounding, market risk, because the more time you have, the more you can deal with that market risk because you can just kind of ignore it, those ups and downs in the market. Pretax and Roth, we looked at the two T's, taxes and time, that factor into how you're going to save, how it provides you flexibility when you get to retirement. And then we talked about the impact of taking money out of your account. Of course, avoid at all costs accessing retirement funds before retirement. But if you have to, know the repercussions, see what's available in your plan, and then know the repercussions. What are the taxes? What are the penalties? How's it going to impact your retirement if you stop your saving and miss out on match? So those are our objectives. Hopefully we accomplish those for you. If we didn't, you can always ask questions here. You can unmute yourself. You can throw them into the chat. You can always follow up with us. I put our QR code on the screen You should be able to snap that with your phone to get to our scheduling page, to put time on our calendars, to talk to us more. That's that same URL that you see at the bottom, our Calendly page, to when it's convenient for you, put time on our calendars. We got more resources at our website. You got my email. You can text, you can call, always available. I'll give you a chance if somebody does want to, you can just unmute yourself and ask a question or type away if you want to type it into the chat. I'll just repeat then that noon Central Time, 5 o'clock Central Time, we'll repeat this. I'll distribute the recording. I think I gave people enough time to chat, to type in. I don't have anything coming in via the chat. Last call on questions if you want to mute yourself. Right. I'll let you get back to your day. I always appreciate you taking some time out to join me. Hope it was informative. And remember that we're always here for you. So reach out if you want to talk about anything more in the future. Be safe. Have a great rest of your day. Bye-bye.